stock market. I mean, the big story in my mind was that inflation is not performing well enough for the Fed to cut rates, but it's performing well enough for the Fed maybe to increase one more time. That's an option they've kept. But probably that would, in any case, not matter very much because it would be the end of the increases. So the fact that the Fed is not increasing anymore and the fact that inflation is starting to perform better means that the bond yields can at least stabilize at current levels or fall a bit. And it is actually the improvement in the bond markets which is driving the equity markets. The question is whether they really should move in lockstep in that manner, or whether the equity market story is a different story, even if the bond story is getting a lot better.
What does it tell you, David, when Berkshire Hathaway slows down share buybacks, despite holding record cash, prefers US Treasuries over equities? Yes, it depends on your risk tolerance, but should allocation be this defensive? Or if this is a selective stock pickers market, then what should we own? What should we avoid?
Well, you know, I'm probably the last person in the world to make judgments about how clever Berkshire Hathaway is, because they're clearly a lot cleverer than I am. But if you want my take on this, it is the following. The conditions for the Fed to keep interest rates where they are, and for the bond market to have yields which have come down a lot from the panic levels, is that the economy is cooling and that the labor market is moving into better balance. And as a result, the wages and salaries increase at a slower rate. Now, all of that tells me that the outlook for equities is not as good as the outlook for bonds. And the reason for that is, for the data to get better, for the inflation to fall enough for the Fed to actually cut, profit margins, which are at least half of the inflation story, would have to contract. And therefore, while the discount factor, let's say, equated to the long-term bond rate plus a risk premium, would be improving and falling, the profits of companies and the profit margins of companies would be contracting as a precondition for the economy to move into the sort of balance which would then allow the Fed to actually cut rates down the road. And that, I think, is what we're being told by somebody as intelligent as Berkshire, or an institution as intelligent as Berkshire Hathaway.
David, good to see you. This is Christine. Everybody's focused on the jobs data, the weak jobs data last week. It certainly makes the Fed's job a lot easier, but it's also one of the best recession indicators as well in the job market. That is, any small increases in unemployment will obviously be enough to trigger a recession. That's what a lot of people are saying. October unemployment is now at 3.9%. Can the U.S. avoid a recession if the unemployment picture doesn't improve?
I think the answer to that, Christine, is yes, it can. It may not, but it can. And the reason it can is really, in my mind, for two factors come into my calculation. The first factor is that as inflation falls back, real income rises without rising in nominal terms, because what you buy in the shops is actually not increasing in price anymore, but wages and salaries are still rising at a rate of 3-4%, whatever you want to take. But the falling inflation rate increases the purchasing power of people, and therefore they do not suffer as much from a weaker job picture than they would otherwise. And the second reason is because American households have done nothing but get richer. If you look at the net assets of American households, despite the fall in equity markets, despite the moderation of increases in real estate prices, they have got, throughout the last year, since COVID, richer and richer. And I think that constitutes a hidden reserve for them to sustain their consumption. Those two factors, to my mind, outweigh the fact that excess savings, you know, the famous savings that were built up during COVID, yes, that's all gone. But the combination of greater wealth and the fact that inflation will improve the real earnings picture, to my mind, outweigh the loss of the, in a sense, safety buffer of excessive savings accumulated during the COVID period. So I would say, yes, we can avoid a recession.